3 of our series on the Vanguard LifeStrategy funds. This time we're going to look at the conservative fund, i.e. the income fund. And the ticker is VASIX, Victory Alpha Sierra India X-Ray, VA or VA6. There you go, VA6. Pretty cool. All right, so if you like what you see here at Heritage Wealth Planning YouTube channel, please subscribe down below. Comments are always welcome, but please subscribe down below and then hit the bell to be notified for future content, because we do lots and lots of videos. All right, so let's dive right into this, because this is pretty interesting. So the premise is that you have the aggressive fund. Remember, we put $10,000 into that in 1994. It's grown to $65,000 basically today. We have the moderately aggressive fund. We put $10,000 into that in 1994. It grew to $58,000 today. But it did so without as much up and down. Now, it had some pretty significant down markets, don't get me wrong, but it's about, we're talking 50% less in 2001 and 2 in terms of down market. And then, 25% less in 2008. Yeah, so, some significantly less downside, but it's still down. It's still down 25%, 26% in 2008. So that's the risk reward, the trade-off. Could you handle a 26% decline in 2008 versus what would have been a 34.5% decline in an aggressive fund? And to do that, you sacrifice $7,000 on a $10,000 investment or $70,000 on a $100,000 investment. That's the concern. All right, so here's the LifeStrategy Income Fund, and let's see what this has. Basically 20% stocks, 80% bonds, essentially. All right, so we have a trailing 12-month yield of 2.31. The 30-day SEC yield is simply what is paid over the last 30 days. That can be a little bit misleading. I remember we had a fund at USA, a bond fund that had like a 6.85% trailing 30-day yield because they had this one-time, benefit payout or something. I can't remember, but it's just a one-time income that they produce. And I remember people calling, I want that fund 6.84%. It's like, look, it's a 30-day yield. It's not the trailing 12 months. The 30-day yield is literally what's paid over the last 30 days. The trailing 12 months is literally what's paid over the last year. This might be more reflective of current market conditions, but you can have some anomalies if there's a quick payout that you weren't expecting. And all of a sudden for 30 days, you're like, whoa, that thing's doing great. I want to buy it. That's bad. I cannot tell you how bad that could be. And it just people fall for it. It's sad. All right. So anyway, so let's look. So we got 20% stocks, roughly 80% bonds. Again, low fees, 0.11, a lower turnover of 4%. So, and that's all the stuff that you want to see. You're getting, for every $100,000, you're roughly getting $2,100 to $2,300 a year in income. Your $10,000 investment in 1994 has grown to, what's that, 41,000 today. So significantly off of the other two. All right. Now, what you can see is not much of a decline. So we'll bring up Yahoo to see what these declines really were, because Morningstar doesn't give us a year-over-year returns, unfortunately. Let's see what's relative to benchmarks. Yeah, so after 40, it's the 40, basically the top half of its peers over 10 years, top quarter over 5 in the top half. So between the top quarter and top half over 5 and 10 years relative to its peers, I bet after taxes it's going to look a lot better, though. And then same thing, top holdings are 56% in the Vanguard total bond, 25 roughly in the international bond, 12% in the total stock index, and roughly 8% in the total international stock index. So bond heavy for sure. Drawback about the total bond market index, and this is one of the things I don't like about bond indexes, frankly, is it's top heavy on the most indebted countries and companies. All right. So stock indexes are market capitalization weighted. That means the higher price and the market value. The more shares, the higher the price, the higher the market capitalization. That'd be a higher held constituent in the index. It's confusing, I get it, but essentially that's what a stock index is, like the S&P 500. You have a stock that has 100 shares outstanding with a dollar per share. That's $100. That's the market capitalization. You have a stock that has 200 shares outstanding with $1 per share. That's a 200 market capitalization. That stock will represent a bigger constituent percentage as the 200 one as the $100 one, if that makes sense. And there's some benefit of that, frankly, because there is a whole theory is you ride your winners. And the things that are having a higher and higher market capitalization typically isn't from stocks being issued, which dilutes the price. Probably way too heavy for this episode here, but generally it's because of price appreciation. So the higher the market capitalization generally is from the stock price of growing up, which is a winner. And you want to keep your winners. And as the winner goes and goes and goes and goes, the S&P 500 is reflected by that relative to its peers because it's riding the winners. And you sell the losers, you cut your losers. So as a stock slowly depreciates in market capitalization, again, typically because of price declines, and that could be from issuing new shares, frankly. I mean, that's inflationary. If you issue more shares, the previous shares that are out there are worth less. And, people are going to, scream bloody murder on that as well. They should. And so generally companies don't do that. So what happens is a company that is losing market capitalization is doing it simply because their share price is going down. Just on a side note, a way for companies to avoid that is to buy back shares. And we'll see that a lot. They might get ready to be delisted from the New York Stock Exchange because they have to maintain, I think it's $5 a share. And so what they'll do is they'll say, oh, we don't want to get delisted and go into the over-counter markets. We're going to start buying back our shares to basically prop up our share price so we can stay on the New York Stock Exchange, because the minute we're a blue chip stock that goes off the New York Stock Exchange, all hell breaks loose and the CEO gets fired. It's way too deep for this. But anyway, it's interesting how that works. So remember, market capitalization is number of shares outstanding times price per share. People say, well, you could increase your market capitalization by diluting the shares by issuing more shares. That you could. No one does that, because if they were to do that, the current share prices will be hammered because their shares will be less valued. There's just no other way around that. The only way truly is for the price to go up. The price to go up means you're riding a winner. You're allowing that sucker to keep going. And if it goes the other way, you're cutting a loss, you're cutting a loser, which is why the S&P 500, generally speaking, does outperform most actively managed funds out there. They're riding the winners and cutting the losers. It's actually pretty fundamental. All right, so enough of that. So what you see here, I forgot where I even got off that tangent. So anyway, so this is nothing to write home about. Top half, top quarter, top half. Is there anything else I want to talk about here? I can't think of anything. All right, so now we're going to go to tax, because this is important. Again, if you have an IRA, I can hear you saying this doesn't bother me. Yes, it does. If a company issues significant 1099s taxation to shareholders, and those shareholders are getting hammered by that, shareholders say, screw that, I'm selling that sucker. I'm going to something that has a low turnover because I don't want to pay taxes on an investment that I don't plan on selling anytime soon. And if they're starting to liquidate their assets, guess who's left holding the wet bag? It's you, the long-term investor. And this happens all the time. All right, so, yeah, look at that. So after tax, is top 40, top 11 over 5 years. So that's pretty good. I'm surprised it's actually as low as it is here. But anyway, at the end of the day, the income fund at Vanguard after taxes is a stellar. 10 and 15 years, not as stellar as I would have thought, but certainly the 5 years in the top 10. If you can find something consistently in the top quintile, I mean, that's a winner for you for sure. And not much in capital gain exposure. Why do you think that is? Guesses? Well, because they don't have much stock. I mean, they only have 20% of the portfolio in stock, so very limited capital gain exposure. So not much in the way of capital gain distributions coming at you anytime soon, especially with only a 4% turnover. Just not a threat to you at all. The issue is the income you receive from this is going to be ordinary income and bonds. So that's the drawback. Oh, that's what I was going to say about the total bond index. Got off track there. So bond index is the same thing as the stock index, the total bond index. The heavier debt companies and countries is going to be a bigger constituent representative of the index. So when you're buying a bond index, you're literally buying the companies and countries that have the most debt, which is kind of scary. And so if you look at the total bond index, I think like 70% of that is government-oriented U.S. government bonds, because by far and away, the U.S. government is the biggest indebted entity in the world. And so it's like 65 to 70% of the bond index is government bonds, which means I bet in 2008, this fund did not get hammered very much at all, if anything, just because they have so much exposure to government bonds, and government bonds did just fine in 2008. All right, so let's see what we want to do here. So, look at that, though. So after tax, 6.16 net, or gross of tax, 4.61 net. So you lost 150 basis points of taxation in this fund. and since inception. Over 15 years, you lost 120 basis points, 1.24%. That's 25% of your portfolio, roughly. You lost to taxation, my friends. And yet this is still in the top 40. Bond funds, you got to look at after-tax returns. That's where you get hammered. In 5 years, you lost 25% of your portfolio, and yet you're still in the top 11%. That's the thing when it comes to income funds. The tax man is chomping at the bit for you to pay those taxes, and you're getting low returns as it is, and then you're losing a significant portion of that to taxes. It's dastardly, and no one talks about it, which they should. So let's go to Yahoo. Let me pause this real quick.